Hello everyone. Today's topic is EPS or earnings per share. You might have seen or heard that because due to an increase in the EPS of a stock, the share price has increased, or due to the decrease in EPS, the share price of a stock has come down. So what is this EPS? So EPS is a number which indicates the profitability and financial performance of a company. EPS says how much profit the company is making. So higher the EPS, better is the profitability of the company. A company which is having a good EPS is investable. An investor can invest in the company which has seen consistent growth in EPS over the years. So in today's session, we will understand the calculation of EPS and also the uses of EPS. Calculation of EPS. How to calculate the EPS? What is the formula to calculate the EPS? EPS is equal to net income minus preferred dividend divided by average number of shares outstanding. We can take an example for this. Suppose there is a company and for the year 2019, that company's net income is 100 crore rupees. The amount of outstanding common shares is 10 crore and the preferred dividend is 5 crore rupees. So EPS is equal to 100 minus 5 divided by 10, that is 9.5. But all the companies might not be having the preference shares, so they might not be giving the preference dividend. So then the formula to calculate the EPS is simply net income divided by average number of shares outstanding. That's equals to 100 crore divided by 10 is equal to 10. You must always take note that there is an inverse relationship between total common outstanding shares and EPS. That means when the total outstanding shares decreases, EPS increases, and when the total outstanding shares increases, EPS decreases. So when there will be a decrease in the total outstanding shares, when there is a buyback, when the company goes for buyback, that means when the company buys its own shares, then the total outstanding shares will decrease and the company's EPS will increase. And when there will be a increase in the total outstanding shares, when the company has issued employee stock option plans, and when the employees convert this into shares, the total common outstanding shares will increase and EPS will decrease. And also when the company has issued warrants or convertible securities to the employees, and when they convert it into equity shares, the number of outstanding equity shares will increase and EPS will decrease. And when we consider these convertible shares along with the normal outstanding shares, it is called as diluted EPS. Let us understand this with the help of an example. Suppose a company's net income is 100 crore rupees, its preference dividend is 5 crore rupees, the average outstanding common shares is 10 crores, and total convertible securities is 2 crore. Then EPS is equal to 100 crore minus 5 crores divided by 10 crore plus 2 crores. That is equal to 7.92 rupees. And that will be the diluted EPS of the company. So when the situation is like this, you must calculate the diluted EPS of the company. So what are the uses of EPS? EPS is helpful for the calculation of PE ratio. So there will be an inverse relationship between EPS and PE ratio. When the EPS increases, PE ratio decreases, and when the EPS decreases, PE ratio increases. A PE ratio has come down. That means the performance of the company has improved, because a lower PE ratio indicates that the company is undervalued. The company is available at a lesser rate, so you can invest in that company. And also you have to analyze the EPS over several years. Let us say 3 to 5 years. If the company is growing its EPS consistently over the years, let us say for 5 years, then you can say that the company is good and you can invest in that company. Because for an odd 1 year, a company might give a good EPS, but there might be some extraordinary income. The company might be having a land which was bought 20 years before and which was bought at a very less rate. So if the company has sold that land, its EPS will improve. But it will be an extraordinary item. So if you analyze the EPS for only 1 year, your analysis will not be sufficient. So you have to analyze or study the EPS for several years, let us say for 5 years. Then only you can say that the company is good, the company's fundamentals are good, the company is performing well financially, and you can invest in that company. Thank you.